Welcome back. We just heard from Treasury Secretary Mnuchin and his plans for tax reform. Now, a leading real estate developer weighs in with us to talk about tax reform and a lot more. Is real estate giant Don Peebles. He is CEO and founder of Peebles Corporation. Don, it's good to see you.
Good to see you.
Thank you so much for joining us. So what's your take on what we've heard so far? What is the impact in your view?
Well, look, I think the impact, first of all, for New York is going to be catastrophic. It will lead to a mass exodus of high-income earners, especially entrepreneurs and business owners who can relocate geographically. I think you'll see that, especially no state income tax deduction and the local pressure on taxes that, the mayor is calling for an increase in taxes on millionaires and a mansion tax increase. I think that's going to also be hard on real estate.
And New York just voted for that for another 4 years, Don.
Yeah, but at the lowest turnout.
Do they know that there's a mansion tax coming, that there's all this new revenue wanting to go to the coffers of New York City?
Yeah, and I think they either stayed home or they voted for Nicole Malliotakis.
Wow. All right, let me go back to the tax plan. An exodus out of New York. Why?
Well, because a couple things. One, no deductibility of state income taxes, and New York is one of the top three highest tax states in the country. And then when you add the New York City tax implications on it, it can be as high as 17%. So you add that and not being able to deduct it, I think it's a pill that people are going to have difficulty swallowing.
So people are going to say, okay, my tax rate pretty much, when I look at federal, state, local, is 53%.
Yes.
Or more.
Or more.
Or more.
I had lunch with someone who's paying 57% the other day.
How does he pay 57%?
Unincorporated business tax.
Unbelievable. So why stay in New York and pay 57% when you can go to Florida and pay?
Zero. And so
what?
Yeah, and now think about, on top of that, there's a balance. Historically, people make the decision that, one, this is a great city full of entrepreneurship and very business friendly and a high quality of life. But as the environment has changed, where the quality of life is diminishing and it's becoming an anti-business environment, then people, I think, are going to say, why stay?
How would you characterize real estate right now?
Uncertain. I think the real estate in New York is at a breaking point. Prices have gone very high, and now there's a big pullback. There's a lot of new inventory on the market. And so at the super high end, there's still demand, and at the low end, which unfortunately is about $2 million and down, those are doing well. It's that space in the middle. And this is the first time, I think, in my career where I have not seen a direct correlation between the stock market and the New York real estate housing market. Normally the stock market rises, so do values and prices and demand for New York City real estate. And it's been kind of the opposite. Stock market continues to rise, real estate's going down a bit.
Wow, that's interesting. Do you think real estate prices continue to get some pressure, go down?
Yes, I think also the psychology of the buyers changed. It's a new demographic out here now. Millennials, Generation X's. They look at real estate very differently than, say, my generation does, where we always expected real estate to either continue to rise or certainly outpace inflation. Now, with the experience of what happened in 2008 through 2011, these buyers are reluctant to buy, and they want more mobility.
Anything else strike you about this tax plan?
Yeah, I think that, the idea that we are treating corporations, large corporations, differently than we would treat entrepreneurs and small business owners is a bit unfair. I think there should be a direct correlation. If you're going to reduce the corporate tax rate to 20, then the pass-through entity tax rate ought to be 20. And then clearly, there's no room to raise the top rate. That's too high as it is right now, because we want our money to not go into the government, but to go back into our economy. But I think that is an unfair approach there, and I think that has to change. And then also they're eliminating the historic tax credit. If they eliminate the historic tax credit program, that's very challenging for real estate in more mature markets, especially on the Northeast Corridor, where we have many historic buildings that need restoration. And the incentive to do that is the tax credits. Taking that away is going to also create problems.
Don, you make so many great points. Thanks so much for joining us today.
Thank you for having me.
Great to see you. Don Peebles there.